Welcome to the daily update. This is being prepared Wednesday, September 21st. Happy fall, where we'll look at the action in the market today and then see how things look for Thursday, September 22nd. And Wednesday was the big day. That's the day that the Fed met. Interest rates, growth concerns, that's the fixation of the market. Today was the day when they came out. They ended up raising rates 0.75%. And the market gyrated all over the place. But most of all, we're still really looking negative. Now, had we gone up, and I mentioned this in yesterday's video, we are currently in a downtrend overall, a bigger downtrend. And once the gyrations finish, we tend to go back to the trend that we were in before. Well, since we're in a downtrend and we had a down day, it's just a continuation of what we're seeing. So let's go back and talk about what happened. Right at the open, things were okay at the open. We actually gapped higher up to R1 at 38.79. And then as the day went on, everything just went sideways. We just didn't see really any price action. And that's pretty common ahead of a Fed announcement. You have the initial open gyration and then things really calm down. Many times they'll have kind of an upward bias to it. Well, it just kind of chopped above and below R1 until the announcement was made. And then everything went crazy at 2 p.m. Eastern. After the announcement came, the first reaction was negative, and we went down below S2 at 38.30. Then all of a sudden we turned around and started to go up. We went to R2 at 39.02. And so things were looking a little better. And then after that, we ended up going negative again down to below S2 at 38.05. And I have an intraday chart. It's a 1 minute bar chart that I'll show you here in just a minute. Actually, it's a candlestick chart. We closed at the low for the session, and that's usually a pretty negative thing. We were down 1.71% on a really wild day. Volume was above average. That is kind of to be expected when you have a major announcement like we had. The technicals are negative, but we're pretty much oversold in the short term, but we could still go further down from here. Just because we become oversold doesn't mean everything has to stop. It just means that things could be running out of steam in the short term, and they may go sideways. We may see a little bit of a bounce to work off that short-term oversold condition. Well, we also have some intermediate term indicators that are starting to become oversold as well. And as I said, because of this whole interest rate fixation that's going on right now, and the Fed speak that came out during the press conference after the announcement was made. So what are some comments? As expected, they did raise rates 0.75% or 75 basis points. And we're right now at 3 to 3.25. That's the range that the Fed looks for. They've also raised what's called the terminal rate. How high are rates going to go before we top out and start coming down? It had been at 3.8%. Well, that got adjusted again to 4.6%. So we're just kind of inching higher and higher and higher. That's also seen as quite negative, since it's not quite a percentage point, but that's a lot higher than the market had been anticipating. So the scenario that the Fed is working with, it's the same one. I don't know why a lot of the market participants are really caught off guard by this and why some of the reaction is so violent. It just came out in that press conference, pretty much what Fed Chair Powell has been saying all along, that the Fed will keep raising rates further, and they'll probably keep them at higher levels for a longer period of time. That can be seen as negative too. They're going to bump up rates, and instead of turning around and coming back down, they're probably going to level off for a while. That's also a negative thing that the stock market is picking up on. And then he also said that it's likely that there's going to be another 1 to 1.25% move this year, still in 2022. So the markets didn't like that very much either. On the heels of that, by the time we closed, all 11 sectors declined, and that's the same as what happened yesterday. The transports are still going down, hitting another 52-week low. I have a Dow theory chart that I'll bring up later on. Stocks are becoming, in the short term and even a little bit in the intermediate term, oversold. But again, like I said, it doesn't mean we have to stop here. It's just things could get exhausted in the short term and possibly even in the intermediate term. The same yield curves that were inverted yesterday are now inverted again today. The 30 to the 5, the 10 to the 2, the 10 to the 5. Sentiment is still, it's tipping down a little bit more. We're still in the fear range, but we're not extreme at this point. On other news that came out, we had the weekly MBA mortgage applications index, and this was actually positive. We haven't seen this going up for a while now. It was up 3.8%. Maybe people were shoving in their applications ahead of interest rates going up. That might explain it. But it was up where we had been seeing the overall trend down. And then existing home sales, they were down 0.4% on a month over month basis. And then they seasonally adjust this to 4.8 million. That's actually a little higher. They expected it to be at 4.7 million versus an upwardly revised 4.82 million, where it had been 4.81 million that we saw back in July. And this just shows that it's the 7th straight month that existing home sales have fallen. To me, that's the key thing. We're looking for the overall trend. We might get these numbers that are kind of outliers or anomalies, but we want to see what's the overall trend that's happening. And the sales of homes, whether they're new or existing, continues to decline. And wouldn't you know, the minute that I start recording, that's when all the tools start. It's almost a photo finish from when I hit the record button. And then total sales in August were down 19.9% when you look back a year ago. So the housing market is really suffering some declines currently. Our trend is negative, and it's gone even a little bit more above 20, but that is still counted as a trend. It's starting to go above the moving average. So we are in a trending environment right now. The bias is negative with the down day, and then the momentum is also negative because the last 2, 3, 4, 5 days have also been negative. Let's go back and talk about what happened. Now, right after the meeting, we're done with the September 21st meeting, naturally. Now we're looking ahead to the November 2nd meeting. And the way things look now, and this is going to jockey all over the place, but there's a 68.5% probability right now that we will be at 3.75 to 4%. We're now at 3 to 3.25. So this would be another 75 basis point move. And most of the folks are in that camp. And that's pretty much what was told to us during the press conference yesterday. So that's the scenario that we're looking at right now. As more economic reports come out, this will adjust. And if they're strong, we might even get back up into the 1% increase. Who knows how this is going to play out, but this changes pretty much every day. Sentiment is still tipping over. As long as we're above 25, we're not getting into extreme fear. This could suggest that we might have some more room to go to the downside, at least on a sentiment basis, based on this index. And here's the historical chart. This is also a little bit outdated. The most recent reading that I have of the Ridex bear bull ratio does show that we're going up a bit in fear, even though it ticked down slightly. This does not take into account Wednesday's action, so it's probably going to go up higher in the next reading. Here's some Isabel Net charts. And again, the debate goes back and forth. On one hand, people like to argue about things and debate things, and that's cool, but does it really matter? If the market's going up, we're in a bull market. If the market's going down, we're in a bear market, and we just take it day by day by day. Well, there's folks that have this idea and have defined something as a secular bull or bear market. That's long-term, and that can last years, if even decades at a time. And then we have cyclical bull or bear markets. And there's some debate going back and forth whether we're in a secular bull market now. Have we switched over to a secular bear market? And people throw this back and forth. my personal stance is, okay, this is interesting. We should know this. We should look at these charts, but does it really matter? Is it really going to influence things as for us as individual investors? We take a day by day approach, and then that forms a bigger picture. That's where I come out with things. But you might just want to look at this chart overall. It's still suggesting that we are in an overall secular bull market. We still have a ways to go before that would be broken. But there's other people that who have a lot more letters after their name than I do that suggest that we are in a secular bear market right now. Another thing that we're seeing is the corporate clients are doing a lot less buybacks right now. Even though it's spiked up, we're seeing the 4-week moving average kind of coming down just a little bit here. Again, and the idea is that if things are looking more positive, people that work in these companies, they'd be willing to buy their own stock because they really know what's going on here. And once that stock is out there, they sometimes will want to buy that back to take some shares out of the marketplace and to make them more precious. Well, we've been seeing that going up overall, but it hasn't really given much support to the market as a whole. Another chart. This is a record share of central banks are in a hiking cycle. They're all raising interest rates. It's up right around 80%. And these are 32 central banks all around the world. This is not just a US phenomenon that we're going through. This is global right now. That's really what I'm getting from this. The percent of yield curves that are inverted, we have gone above 60% now with these. Now, I don't follow all of the yield curves that they're talking about here. I have 4 or 5 that I follow, but this continues to go up. And the more this goes up, the more likelihood there will be a recession. And again, we're going back and forth. Are we in a recession now? If not, are we going to be in a recession? Just what is a recession? This is the bullish sentiment versus the bearish sentiment. And we'll have some other sentiment indicators coming out, like the AAII and the asset managers. It just shows that people are getting pretty pessimistic, but not necessarily as pessimistic as we've been before. So this also could suggest that we might see some more downside before we get to that capitulation stage where everybody says, I don't want to own any stocks. Just get me out. I don't care if what I lose. I bought things on margin. I have to sell because I owe this money back to my broker and everything's going crazy and it's panic. That's when we tend to see a bottom. And we're not necessarily at that point right now. This is also showing that investors, they tend to be long or into the healthcare stocks the most. That's a value play. Staples and then energy. These have been some of the better performing areas. And there's in the banks, because as interest rates are going up, you'd think banks would enjoy more profits. Well, on this, as we go down this chart, these red lines just show the sectors that are shorted currently. And you have discretionary, which has been holding up kind of well lately. It's been actually, I mean, it's getting hit and it's still in a downtrend, but the last week or two, it's kind of been outperforming some of the other areas that we look at, but people are still heavily shorted in those stocks. This is, and again, this chart is before the Fed made their announcement, where here we are right now. A week ago, we thought that we would top out at maybe around 4%. Well, now it's coming up to the 4.4, 4.5 area, and it's even adjusting more based on some of the other comments that I made earlier. And then once it finally tops out, then that's when interest rates will start to come down. Okay, this is all fine and dandy, but if we're right in this area right now, kind of around the up right in here, well, it could be really nasty from between now and the time that we finally do top out with interest rates. We have an upcoming election. Sometimes that can provide some support, but the election's still a little ways off. So it could be some pretty difficult times between now and the time the election rolls around. This is also showing how that there's a lot of outflows in small cap stocks when you compare them to large cap inflows. And this just shows that maybe small cap stocks are cheap. But we've been seeing this for a while. I've showed a lot of different charts that are showing the same thing, but it hasn't really shifted yet. And that's why we watch the small caps too. They've been underperforming, and especially on a relative basis. And we want to see, is that going to continue? Because this could give some support to the market if folks start to get back into the small caps. This is another one that deals with real estate and housing, where this is new privately owned housing units that are authorized in the permit issuing places. When this goes up and then starts to come down, typically we go into a recession after that, where it tops and then reverses, tops and reverses. Well, we've potentially topped here and we're starting to come down. So this would suggest that at some point in the future, we will be in a recession if we're not already in one now. We also had another update of the GDP now. They're lowering. It was at 1.5 a week ago. Then they came down and lowered it 1% to 0.5. Now they've lowered it again to 0.3. And they're really fighting hard to keep this thing positive. But if things continue to show more weakness, even the forecast might suggest that we will have negative GDP for the third quarter. And that would just confirm this whole recession idea that we've had two. Now, these are forecasts here and not the real numbers necessarily, that we have had 2 quarters back to back with negative GDP. And that's the textbook definition of a recession. But then you have other folks who are trying to slant this in a different direction, saying, but yeah, the employment situation is still doing quite well. And that's true. So that's why we want to keep an eye on what's happening with employment as well. All right. In the day's session, everything got hit. You had growth down 1.76%, and even value was down 1.6%. But everything was red across the board. Not a positive day, but we're not seeing a real spike up with the VIX. Yeah, it increased both with the line chart and on the bar chart, but we're not up at these stratospheric levels that usually suggest that we've hit some kind of a bottom in the market. And the VIX of the VIX continues to pretty much go sideways right now. The Ulcer Index is going back up. This is a fear measurement. So as this is going up, that just means there's more fear coming into the market. The mass index, we're just watching this to see if eventually a signal will be generated. And that won't happen until this line gets up to the blue line. We're in bear market territory again now. We're down 21.35% from the all-time high. And the equity put call ratio on the daily chart did spike up as we were going lower, but we're still trending down slightly with the 5 period. Looking at support and resistance, we had a really big swing, and I'll go through this chart and talk a little bit more about it. But these are the pivot points for Thursday's session, and they're pretty wide apart from each other because we had such a wide swing in Wednesday's session. But we broke down below support on the daily chart. And could we continue to fall lower? There's really not a lot holding us up right now unless we match previous lows, unless another index hits some kind of a support level, and that produces a bounce that is followed by the S&P 500. But we're kind of free falling right now, but we are, and at least in the short term, getting to an oversold condition. And we can see where volume did pick up to be above average. Here is the monthly pivot levels, which some of you might find useful. I use them on the daily charts. And then here's the Fibonacci. Going back from the low set in June to the high set in August, we've retraced pretty much all of that. We're below the 38.2% retracement, and now we're falling down. And so you're hearing a lot more talk, and our charts are suggesting this as well, that maybe we're going to go back to the June lows. We might actually fall down to that level. We've broken all the trend lines that were kind of giving us some support. So now, are we going to go back down to this level? Then you have people saying, will it be a successful test where we bounce up off of that? Or are we going to even fall down below that? Here's a longer term look at some Fib levels where this overlapping Fib level that had been giving us some pretty solid support, well, we fell down through that. Then here's the weekly chart. We also fell through the 38.2% retracement where we had been holding up above that. Now we are below that. Here's the trend channel. We're coming right back down to the midpoint of this trend channel. Will we get some support off of that, or are we going to fall down even further? Looking at the sectors, everyone was negative, with communication, discretionary, and materials leading the way lower. Financials, they were down all over 2%. Staples were down, but were down just a little over 1/3%. Here's our technical analysis scooter scores. It shows utilities and energy still have pretty good looking charts, but communication has a really bad looking chart right now. Here are the sectors showing with that energy has held up the best, even though it's given back some of its gains. Utilities are positive, although they've given back gains too, where all of the other sectors still continue to be negative. Here are the updated percentage moves since the all-time high in the S&P 500, which is in pink. And it's just showing how the NASDAQ and NASDAQ 100 are leading the way lower, where you have the NYSE and the Dow that are down, but holding up better. Our technical alerts, some positive, some negative. As far as the S&P, we did get above 3,900 there briefly, but then we went below 3,900, then we went below 3,800. So, I mean, it's a real wild day. And the dollar, it likes the fact that interest rates are being raised. So it's setting a new 4-year high, and we actually got above 110. I'll have a chart to show you that. So it was pretty wild. Our scores, we still have the mid caps in the lead at a paltry 56.1. It was up 0.1 in this latest reading. So even though this is in first place, this is still pretty sorry looking, followed by the Dow at 50.6. Small caps, they were actually up slightly in their score, but they're at 43.9. The S&P is at 39.8. It is also showing a weaker chart, and the Qs have dropped below 20 at 19.9. So none of these charts are looking very healthy from a technical analysis standpoint right now. Now, if you're bearish on the market, you're just getting all excited right now. But if you just go into the long side of the market, buy low and sell high, you're not very happy with things right now. Here is the intraday chart where we gapped higher to R1 and then just danced along this until the statement came out or the announcement was made. The initial reaction was negative, shot us down to below R1. Then the market said, well, wait a minute, maybe things aren't so bad. Then it took us all the way up to R2. And then people said, oh, maybe that isn't so good. And then as the press conference was going on, this is when we saw the real decline. And we ended up closing right at the low below S2. Here's a 1-minute chart where this is right when the announcement was made, the initial negative reaction, a little bit of bouncing. Then we shot all the way up and we're able to get back above 3,900. But as I said, that didn't last very long. Then we kind of bounced sideways a little bit. And then, as I said before, as the press conference went on, it just went down and down and down and down, and we closed at the low. Not a positive day. The ADX is showing that we're turning back up and we're slightly over the moving average. So this is a trending market. The red line's on top, so that is a negative trend. The Arun continues to get kind of extreme when you compare the buying and the sellers together. So that could also suggest that we're getting near an oversold condition. Breadth was pretty bad. We saw real declines based on price and volume. And our advanced decline ratio is also declining and not necessarily extreme. Currently, new highs, new lows. We saw another expansion of new lows. So our 5 is rolling over and our 10 continues to decline. Accumulation distribution still above the moving average, but did decline. Short-term charts, and this is where we're looking the most vulnerable right now. However, maybe we overdid it. Now, we've overdone this 2 days in a row. We went extreme negative yesterday with the advanced decline ratio. Well, we've gone extreme negative after today's session as well. The rate of change going back 5 periods is starting to get extreme negative, suggesting that we might be becoming oversold. We're back below the anchored moving average. We were kind of dancing along that, a little bit above, a little bit below. Well, we've really broken below that. Currently, the Stoke RSI is extreme negative. Williams percent are extreme negative. The force index is negative and not hitting this Keltner band, so we're not necessarily extreme there. Declining with the Swinland trading oscillator and not necessarily extreme. So this might suggest there's more room to go. But we are getting extreme with the McClellan oscillator. We're extreme with the 20 and the 50, and we're declining with the 200 in our moving average study. The short-term stochastics, extreme, intermediate is extreme, and we're still getting back to extreme with the long-term stochastics. Intermediate term, the 19-day exponential moving average of the advanced decline ratio, we are showing continued weakness and not necessarily extreme based on price, weakness based on volume, and again, not necessarily extreme yet. Rate of change going back 20 periods, starting to get extreme negative. The Sean trend meter is showing weakness. The PMO continues to decline. The PMOs that are rising, starting to be extreme negative, as are the buy signals, and we're declining with those PMOs that are above zero. After giving us some positive hope over the last couple of days, the Chaikin oscillator had been advancing. Well, with today's decline, it turned down. Chaikin money flow also is still positive, but showing some weakness. Volume kind of picked up a little bit. We had been below average there for a while, at least in Monday's session and Tuesday's session. We are still negative with the sell, the red line being on top and the green line on bottom, so the vortex is negative. We're declining and dropping below zero with the summation index based on price. We're also declining based on volume, and we're already below the zero line. The slope's finally kind of waking up and going, well, maybe I shouldn't be going up after all. Well, it's turning over negative, and all of our other oscillators are negative. The BPI is dropping and getting down to this point where it might get extreme negative soon. The ease of movement kind of flattened out. Ultimate oscillator declining. Money flow flat to slightly lower. The CCI extreme negative based on 14 periods and getting extreme based on 20 periods. The RSI based on 9 periods is starting to go extreme negative, but we still have a ways to go with the RSI 14. Boom indicator, haven't shown this in quite a while. This is a 50-period moving average, and we're starting to get down to an extreme negative reading. We are declining when we look at our 200-day moving average, and that still has more room to fall. This is also suggesting that maybe short to intermediate term, we might be getting oversold. Here's the Dow theory chart where, yeah, we're going down with the Dow, but we haven't set a new 52-week low yet, where now we've had back-to-back days of new 52-week lows with the transports. And if you include utilities in Dow theory, yeah, the utilities have been declining, but they have a long ways to go to get back down to their low set earlier. TTM squeeze, it finally switched over to a darker bar. This is more negative now. When they're pale, that's positive, or at least we're moving in that direction. When it switches darker, that means we're kind of more neutral now with that chart. Balance of power rolled over just a little bit, but we're still above the dashed line. We have confirmation now with the CMB composite index. This is a full-blown sell signal with confirmation. Our different charts, Heikin-Ashi continues to be negative. We're negative with the Kegi, negative with the Renko with two solid boxes. We're declining with the 3-line break. We added another zero here. So we're kind of breaking below this trend line that had been positive for the point and figure by adding another zero. The Elder is negative for the S&P and for the SPY. The SAR continues to be negative. Our go, no-go system remains with a lot of smoke on the water with deep purple. We are declining and possibly getting extreme with our 50, 150 studies, and we're even getting a little bit extreme with our 200-day study. The special K continues to decline. Here's another look at the trend channel. I don't know why I included two of these charts, but we're coming down to this level. We're right at an interesting point of support. We could still fall a little bit more, but if we break down below this, that would be much more negative. The diamonds are back to, or continue to be negative. And here's the Dow, which had been holding at S1. Now it fell through that. The Qs are negative after being neutral. They also broke through S1 after holding that. And we got some really crazy data coming in with the Vixen. But so I'm looking more at the line chart here where it did go up and not necessarily giving us an extreme reading. Doesn't necessarily mean that capitulation has occurred yet. The NASDAQ also broke through S1 support, as did the mid caps, and the Wilshire also closed below support. The dollar just continues to shoot to the moon. And when you look at the dollar against the S&P 500, they are still having a pretty strong tendency to go in opposite directions. Gold, it was up almost 0.5%, but it was gyrating around pretty good. Silver was up 1.86%, but it has a lot of repairing to do to get back to a positive trend. Oil declined down to 82.94. And when you compare the S&P to oil, they're having a tendency to go in the same direction, which is down. Looking at bonds, they continue to fall as interest rates go up, and we're well below the COVID low with the World Bond Index. And because stocks and bonds are both going down, they're having a tendency to move in the same direction. Our yield curves, the same as what we've been showing, the 10 to the 5, the 10 to the 2, the 30 to the 5. We're still watching the 10 to the 3 month. It has yet to go inverted. If that does go inverted, that's probably going to be a big deal just because it's been hanging out here for so long. And there are some really respected economists out there, with Edward Yardeni being one of them, who is, until this goes inverted, he's not fully into the recession camp. The tech sector to the 10-year, they're also having a tendency to go in the opposite direction. Here's how especially the 30-year, it really spiked up. But overall, interest rates continue to go up, even though we saw a bit of a decline in the 3-month. Our scenarios, really not getting anything from these, just to update the charts where we're kind of going off of a Copic curve signal. That means something big could happen. And here's an update of the 200-day simple moving average chart. And here's the 50-period moving average. And these could all be getting ready to go down and set new signals for us. Here's the 10-day average of the highs minus the lows, also showing continued weakness. Broad market, we're not extreme, but we are showing some weakness with the highs minus the lows. The equity put call ratio is not really spiking up now. It's not going up the way you would think it might. Currently, the small caps also closed below support. And the small cap ratio, because they didn't do quite as bad as the S&P, actually turned up slightly, but we're not seeing a spike right now to give the S&P any kind of support. The S&P to the 10-year also going in opposite directions. Here's our sector rotation. We're seeing discretionary show some weakness, but it's still above the moving average. But our other areas are still showing weakness on both of these charts. The S&P to the 2-year also going in opposite directions. So now we're just wondering, when will a new spike be created? we're going higher and higher pretty much every day right now. So it's just going to keep spiking up. The S&P to utilities, the S&P still continues to underperform. We want to see this turn back up. That would give some support to the S&P. As long as it's going down, that produces headwinds for the S&P. Staples were down a little over 1/3%. And even though we haven't come back to this spike, we are seeing this coming back up. So we want to keep an eye on that, see if we're going to actually surpass this spike and set a new spike at some point. So what's our outlook? The technicals are negative, and even though the improvements are fading, we're pretty much getting oversold at this point. We do have the second quarter current account balance report, not a big market mover. Jobless claims, the leading economic index, again, not a really big thing. And all the geopolitical concerns. There's some more concerns coming out from Russia and Ukraine that there's some rhetoric at this point about escalation possibilities. So that could always switch into something that's pretty scary. But the markets are still really fixated on the inflation and interest rates. So our scenarios, we pretty much have to go with the down scenario. There's just a lot of headwinds hitting the market right now. The technicals are negative. Yeah, they're becoming either short or intermediate term oversold, which may slow things down. But overall, we're still down. And we just can't go with the up scenario unless you are super, super daredevilish risky. If we are oversold, we might get some kind of a bounce out of that, but not enough to really switch our scenario to positive because the technicals are just so negative and we're dropping support levels. And we're not sideways any longer because the ADX is above 20 and the red line's on top, so it's negative. So our conclusion, negative, negative, but oversold, negative, but becoming oversold in the intermediate term, and still decidedly negative long term. So thank you. I hope you find this useful and that I'll just watch the market action. If we have kind of an interesting day, I will prepare a full-length video for Friday session. If not, I may just end up doing a daily brief.